Hello and welcome to this deep dive into what I believe is the most overlooked income strategy of the decade, the sovereign energy credit play. While most investors are chasing volatile tech stocks or low-yield savings accounts, a quiet shift is happening in the global energy markets. We are seeing a convergence of government security and massive energy demand. This isn't just about utility bills, it is about sovereign-backed debt instruments that fund critical infrastructure while paying out substantial dividends. Today, we will unpack how professional wealth managers are securing yields that far outpace inflation. If you are looking to scale your venture or optimize your family office's returns, understanding this hidden powerhouse is essential. We're talking about a market that is not just resilient, but is actively being subsidized by national interests to ensure energy security. Let us explore how you can position yourself in this high-return dividend ecosystem. To understand the opportunity, we must first define what sovereign energy credits actually are. Unlike standard corporate bonds, SECs are debt instruments or credit facilities issued by or guaranteed by national governments, specifically for energy projects. This includes everything from traditional oil and gas midstream projects to massive green hydrogen plants. Why does this matter? Because energy is a matter of national security. Governments cannot afford for these projects to fail. This creates a unique credit floor for investors. You are essentially stepping into the shoes of a state-level lender, but with the liquidity of the modern financial markets. These credits often carry higher coupons than standard sovereign bonds because they are tied to the productive output of energy assets. In essence, you are getting paid a premium to facilitate the movement of the world's most vital resource. The reason this opportunity is so lucrative right now is the massive funding gap in global energy. According to recent data, the world needs an annual investment of $4 trillion to meet the 2050 net zero goals and maintain current energy security levels. This supply-demand gap in capital is where you come in. Private capital is being incentivized through sovereign credits to fill this void. As traditional banks pull back due to regulatory constraints, sovereign-backed vehicles are offering higher yields to attract sophisticated investors like you. We are looking at a 30-year tailwind. Whether the world moves to renewables or stays with liquefied natural gas, the infrastructure requires sovereign-level credit to function. This is a structural shift, not a cyclical trend. By capturing this credit spread, you are participating in the largest infrastructure build-out in human history. Now, let's talk about the numbers that matter to your portfolio. While 10-year government bonds might offer 3 to 4%, sovereign energy credits are currently yielding between 7 and 12% annually. This is a massive premium for an asset class with similar security profiles. These yields are often paid out as quarterly dividends, providing a consistent cash flow stream that can be reinvested to scale your wealth. When we compare this to the S&P 500's average dividend yield of less than 2%, the advantage becomes clear. Furthermore, these credits often include inflation adjustment clauses. As energy prices rise, the value of the credit and its associated payout often scales accordingly. This makes SECs one of the few high-yield instruments that doesn't lose its purchasing power in a high-inflation environment. As professional investors, we don't just look at returns, we look at risk-adjusted returns. The beauty of the sovereign energy credit play is the underlying credit quality. Many of these instruments are linked to AA or A-rated sovereign entities, particularly in energy-rich regions like the Middle East or North America. The risk of a sovereign default on energy infrastructure is historically very low because these assets generate the foreign currency reserves needed to pay back the debt. It is a self-liquidating cycle. We look for senior secured positions within these credit structures, meaning you are first in line for repayment. This level of protection, combined with a high-yield coupon, creates an asymmetric risk-reward profile. You are getting equity-like returns with debt-like security. This is how the ultra-wealthy protect their capital while continuing to grow it aggressively. Not all energy credits are created equal. Currently, we are seeing the most significant opportunities in two specific regions. First, the MENA region, Middle East and North Africa, where governments are aggressively diversifying their energy mix and offering high coupon credits to attract foreign capital. Second, the North American midstream market, where sovereign wealth funds are increasingly partnering with private credit to build out LNG export terminals. In these regions, the contractual frameworks are robust and the sovereign guarantees are ironclad. Emerging markets also offer higher yields, sometimes exceeding 15%, but they come with currency risk. For most professionals, the sweet spot is the 10 to 12% range found in the developed and stable energy exporting nations. By diversifying across these geographies, you can build a resilient income engine that is not dependent on any single country's economy. How do you actually get into this play? For most individual professionals, the entry point is through specialized ETFs or closed-end funds that focus on sovereign energy debt. These provide instant diversification and professional management. For those with higher net worth or family offices, direct placement and private credit funds offer the best terms. These private vehicles allow you to negotiate senior positions and capture the full credit spread without the fees associated with retail products. Another option is looking at project bonds listed on international exchanges, which are specifically tied to a single energy asset, like a solar farm or a pipeline. The key is to look for sovereign-wrapped instruments. This ensures that even if the project faces delays, the government's credit stands behind your interest payments. Start small, understand the covenants, and then scale your position. The window for these high-return sovereign energy credits is wide open, but it won't stay this way forever as institutional capital floods in. By acting now, you are locking in yields that can form the bedrock of your passive income strategy for years to come. Remember, in a world of uncertainty, energy and government guarantees are the closest things to a sure bet. Review your portfolio today. Are you overexposed to equities and underexposed to high-yield credit? Transitioning even a small portion of your wealth into this sovereign energy play can significantly enhance your risk-adjusted returns and provide the cash flow needed to fund your next big venture. Thank you for joining me. It is time to stop being a consumer of energy and start being a financier of it. Take the first step. Do